Just for the record, we did try to get Bob Pisani's mother to speak later today, but she was busy. Okay, our next interview, we're very happy to, this is the first time we've had to see a CFTC chairman speak at STA, and we're very happy to have Chairman Behnam with us today. For those who don't know Chairman Behnam, he was sworn in as the CFTC's 15th chairman on January 4th, 2022, by being unanimously confirmed by the U.S. Senate. President Biden nominated Chairman Behnam to lead the agency. Previously, Chairman Behnam did serve as the CFTC commissioner. His arrival at the CFTC followed extensive experiences in the financial and agricultural markets as senior counsel to Senator Debbie Stabenow of Michigan, chairwoman of the U.S. Senate Committee on Agricultural and Nutrition and Forestry, and he primarily focused on policy and legislative matters related to the CFTC and the U.S. Department of Agriculture. Moderating the panel discussion, managing the interview today is Hope Jarkowski. For those who don't know, Hope is the general counsel of NYSE Group. And prior to assuming the role of general counsel in 2022, Hope was head of the equities for the NYSE with responsibility for strategy, product development, and relationship management across NYSE's 5 equity exchanges. Thank you very much, and good luck. Thank you.
Thanks, Jim. Chairman Behnam, thank you very much for being with us today, helping to expand the aperture of the Security Traders Association to other asset classes. It's going to be a great conversation, so thank you very much for joining us today.
Great to be here.
So suffice it to say, since you became the chairman after finishing your term as a commissioner, there have been a number of hot topics in the industry. We're going to get into some of the novelties that have happened in the last couple of years, but 3 big ones stand out and I think resonate across the financial markets: crypto, cloud, and AI. You really can't have a conversation about the markets without one of those topics coming up. So perhaps maybe we'd start with crypto, because there are a lot of obvious jurisdictional discussions going on at the CFTC and the SEC. There are proponents on Capitol Hill who are looking to advance legislation. You've had a lot to say on the topic, and so curious what you can share with this group about how we should be thinking about those specific areas, how your agency is tackling them.
Yeah, thanks, Hope, and it's good to be here among this group and share some thoughts about what we're doing at the CFTC. Crypto, I could probably take the whole half hour, but I'll try to keep it short. As Hope mentioned, I started at the Commission in 2017 as a commissioner, and this actually coincided with the listing of the first Bitcoin futures contracts on CME. SIBO also listed them briefly around the same time. And that just really, in my view, started an avalanche of a policy conversation around digital assets generally. It was certainly early days, but a lot of questions about the underlying cash market, its transparency, what role we could play from a CFTC derivatives perspective in terms of linking the derivatives with the underlying cash, and how credible these futures contracts would be. And vividly, and this is 2017, so we're talking about 7-8 years since Satoshi's white paper and the original founding of Bitcoin. But from that point on, it just felt like we were on a rocket ship about policy debates and discussion. And as you pointed out, there was, and there continues to be, a very stark contrast in those who are supportive, those who are skeptical and oppose. And obviously, this is an interesting week as we see litigation around one of the bigger platforms and the individuals who ran it. But I've always thought to myself, we have to be mindful of my responsibility as then a commissioner and now chairman around this emerging asset class, how it trades on regulated CFTC exchanges, and then how it trades off exchange, in an area that is essentially a regulatory vacuum and continues to be now 6 years later. So I spoke about this area a lot as a commissioner, but have been a bit more vocal as chairman, having sort of control of the agenda and the policy of the agency, speaking directly with members of Congress, and identifying what I stand by to this day are gaps in this space. And there are a couple components or ways to look at this, and I think from my shoes, and I would welcome you to put yourself in my shoes for a day, it's I have to think about customer protections. I have to think about financial stability and market resiliency. And what I see and what I've continued to see is an unregulated market. So I've gone to Congress. I've been very clear in sort of advocating for more legal authority around crypto and trying to bridge, Hope, the point you made is this jurisdictional gap, which is very unique to the US, that we have 2 market regulators. It's historic. It's not going to change, and I think we have it built for good reason. But ultimately, we have a situation where you have cash and derivative securities regulated, and then you have commodity derivatives regulated. But what you don't have regulated is commodity cash markets. And again, for good reason, because historically cash commodity markets are agricultural products, energy products, metals products that, no space for a market regulator, as opposed to, what we heard a little bit earlier, right? This is commerce and this is the commercial code and contract law. But now with technology changing, now with a growing capacity for retail investors, and I think investors across the board, to have access to markets, we have to change. We have to evolve, and we have to think about new asset classes that are going to emerge and how we regulate them. Because, again, as we heard earlier, I'm a proponent of U.S. markets and the U.S. economy, and that's in part because we have the strongest, most clear, defensible, and accountable legal system in the world. And I think that gives confidence to market participants, both for capital allocation and just participation across the board. So it's been a tough ride, I would say, over the past couple of years, because there are, in fact, opponents. But there's been a number of legislative efforts in both the House and the Senate. Obviously took a little bit of a pause last year with a number of failures and bankruptcies in the crypto space. This, to me, feels like something that's inevitable. When it happens, as we're approaching, obviously, 2024 and an election year, remains to be seen. Obviously, a lot going on the Hill right now, shutdowns, elections, and whatnot. But this remains to be a priority of a number of members of Congress, again, on both the House and the Senate side. And it's just a matter of that sort of process, the friction of partisanship and debate and policymaking that hopefully will come up with a sound policy that gives us additional authority over the commodity markets and, of course, gives the SEC what it needs to regulate the security market. So, a lot to be seen. The markets are a bit flat. We've seen that in the price, most notably of Bitcoin, but suspect that this is going to, generate an interest down the road. And again, focusing on what is my number one responsibility and our mission, we have brought 120 to 130 enforcement cases in this space going back to 2014. And this is with limited authority. And I'll briefly explain this. We can police cash markets, cash commodity markets, if there's fraud or manipulation. The underlying sort of policy thesis is if there's fraud or manipulation in an underlying cash market, that manipulation or fraud will be reflected in our regulated derivatives markets. So we've brought a number of cases bringing charges, billions of dollars against big name institutions and individuals. But to me, and I've said this many times, it's the tip of the iceberg, right? It's regulation without registration. It's regulation without surveillance. It's regulation without being able to engage with registrants and market participants. It really is relying on nothing more than tips, complaints, and whistleblowers bringing information to us after the fact, after the frauds occurred, after the manipulations occurred, and most importantly, after the money's lost. So that's not an efficient system. That's not what we stand by and stand on, I think, from an American perspective. And that's why I think we need to change and adapt to this new asset class.
Yeah, there's a lot going on this week, as you point out. So we'll see where the chips fall over the course of the next year with Congress and all the good work you've been doing with that group of constituencies. Taking a broader view, we have a lot of folks in this audience who are either themselves or with their clients tackling bank capital and the changes that are forthcoming with Basel III Endgame. Which are going to put, arguably going to put constrictions on the capital markets, on the day-to-day lending that banks can do, even extending into the mortgage market. How are you at your agency tackling through the FCM approach to the Basel III Endgame, and what are you seeing in this space? What should this group be thinking about?
Yeah, I mean, it's an area where it doesn't have necessarily a direct impact on our regulated entities, and you pointed out it's mostly the bank FCMs, which make up the statistics are actually a bit jaw-dropping, and to give a little bit of context, I said this last week in Chicago as well, because it's such an important statistic, but 25 years ago, roughly, we had about 125 to 150 FCMs, future commission merchants, clearing, a bit of concentration in the largest FCMs, as you would always expect. But today, we're down to about 53. So a huge loss in terms of liquidity and competition, quite frankly. And this is in part, I think, because of the macroeconomic environment. Low rates becomes a very hard sort of business model for FCMs. And what I think about currently, we got 5 FCMs that clear 70 to 80% of futures and swaps. And we think about financial stability risks. We think about a lot of the events that we've faced over the past few years. If I lose one of these FCMs, or imagine, a second, and these are the types of scenarios we run, this would, cause a significant amount of damage and stress to the clearing system itself if we don't have that capacity to clear products. You would obviously see huge amounts of volatility in different asset classes as well. So thinking about Basel III and the end game, I've been talking to, counterparts at the Fed, Chair Powell and others, and Vice Chair Barr and Treasury as well, just to make sure that they understand, because I'm not going to step on the position as it relates to the bank holding companies per se, but we have to be mindful of the intended and unintended consequences of regulation. And I haven't necessarily drawn a conclusion yet. We're doing analysis internally at the CFTC. We want to come up with our own data and our own facts and our own conclusions about what the impacts, both intended and unintended, would be around the end game. But certainly, my starting point is always this concentration risk issue and what we've seen in the markets over the past 2 decades for a variety of reasons. So we need to ensure that this diversity of participants, this competition, and not having this concentration of both onboarding and offboarding clients is limited to a few, in this case, systemically important banks. So we'll be tackling that issue from that perspective. I know the comment period, I'm sure many of you are going to be contributing to that, ends next month, closer to the end of the month. And as the prudential regulators think through this issue, we'll again contribute our expertise and our angle from the derivatives perspective about what impacts this would have. But certainly in interconnected markets, a lot of volatility, a lot of uncertainty, a lot of once in 100-year events happening, unfortunately, more frequently than 100 years. And that puts a lot of strain on certainly derivatives markets. And these are just so critical to capital markets generally from a risk management perspective. So we want to make sure that liquidity is there, that competition is there, so we don't see this unnecessary volatility.
Okay, well, more to come.
Yeah.
I'm going to read a quote from a speech you gave last week at the FIA Expo in Chicago. You recently noted that the onus is on the market and its participants to determine which innovations add value and which end with novelty. So a few notables over the last couple of years. Maybe we'll start with one that is particularly relevant leading into 2024, which is the Kalshi election outcome product that the CFTC recently did not allow to go forward. Maybe for this group, if those aren't familiar, you could give a quick overview of what that was, what it represents in terms of future product approvals, and how you're thinking about it.
Yeah, a little bit of context, and not necessarily unique to this particular registrant, but much like what you're experiencing today in your markets, wanting new products, new ways to allocate capital, new ways to manage risk, new ways to get exposure to different assets. Traditional derivatives markets focused obviously on ags and energies and metals on the physical side, and then rates and currencies and credit on the financial side. But just a growing demand from new entrants and new participants to want new products to both, again, get exposure and to hedge risk. So this conversation around election contracts is not necessarily new. It's actually, it was a first impression over a decade ago, probably back in 2010, 11, or 12. And it's really just, can we manage business risk? Can we manage individual risk based on the outcomes of elections? And I think we all know, depending on the outcome of election, that obviously impacts policy, and policy affects any number of things, both from the executive branch, but also the legislative branch. We've seen that with President Biden for sure, but also predecessors, and we should suspect that in the future. Within the CFTC, and I'll sort of get into the legal analysis, we do have a provision, and it's kind of rooted in what historically has been a test around economic purpose. So basically, if you're a registered exchange, you can only list contracts that have an economic purpose. So you can obviously draw the connection between, a soybean contract, a crude contract, or an FX contract. But then, as you get farther down the curve of contracts and the creativity and the novelty, you have to beg the question of what's that intersection between economic purpose. The economic purpose test was ultimately dropped a number of years ago, but we do have a provision in Section 5 of our law that prohibits contracts that have to do with war, assassination, terrorism, anything that's illegal, and anything that's not in the public interest. And the last one also is gaming. So you think about all this list of categories that essentially create a barrier to entry for different participants and contracts. Some are more clear than others, right? War, assassination, terrorism, something that's illegal. Gaming requires a bit of legal analysis, and then obviously public interest sort of looped in as a sort of blanket to all of those also is a bit gray and gives the commission a bit of leeway. So over time, we've analyzed these contracts, as I said, historically about a decade ago, but then more recently with a few participants who are trying to create essentially binary options, so up-down contracts on who's going to win an election, who might have the gavel, which is still unknown in the House side, or who might be the head of the Senate and whatnot. And ultimately, the decision, Hope, which you referenced a few weeks ago on this particular contract, was that they're prohibited. And they're prohibited under an analysis around that gaming provision within that statutory section. And there's legal analysis that will probably put you to sleep. I welcome you to take a look at it if you'd like. I don't suspect it's going to end here. There's a lot of eager, ambitious, entrepreneurial folks who feel like this is an important component of financial markets and risk management markets. But I'll say this, and I've said this in the past, I talked about crypto and this civil enforcement authority we have over cash markets, and it's limited to fraud and manipulation. So in this scenario where you had a listed election contract, you name your candidate in your district in Iowa, if there is suspicion or an allegation of fraud or manipulation around an election, it then makes the CFTC essentially an election cop. And I'm not comfortable with that. I don't know this for sure directly, that my colleagues will be comfortable with that. We don't have the expertise, and I think that just crosses a line that Congress certainly did not intend the Commodity Futures Trading Commission to be an election cop. And in this environment of news that is available, content that is available 24/7, news that is not necessarily savory or true and has to be verified, I think you can imagine a lot of scenarios where there might be allegations of a candidate or another doing something, not doing something, obviously what we dealt with in terms of 2020 and some of the voting issues. This would put the CFTC in a position which I don't think A, it has the capacity to, or B, it was intended to. So this is one of many tricky issues that I think we're dealing with because, I think it demands and deserves potentially a debate in Congress. But for now, given the state of play, given the existing law, and given our capacity and what I believe our responsibility is, that is a line that I don't want to cross, both from a legal perspective, but also from a policy perspective, which I think resonates with an audience more than anything. Again, the legal analysis will put you to sleep, but I think the fact of the matter of us being an election cop in this environment is probably not in the best interest of our country and the success of elections.
A lot of other things for you to tend to besides the election front. So another hot topic that we've seen a tremendous increase in market share in options over the last couple of years, and even more so this year in zero-dated options. Market participants are using these to hedge risk relative to macro events. Any thoughts on that space?
Yeah, I mean, it's another example, I think, of the theme we've been discussing, over the past 20 minutes is reduced barriers to entry for investors, both institutional and retail, higher demand for new asset classes and new products to manage short-dated or different types of risk, and technology as the sort of overlay facilitating the ability to create new products and create access for institutions and retail participants to invest their money and allocate their capital. From my standpoint as a regulator, we have this very unique provision, again, in our law about supporting responsible innovation. So on the one hand, I have that as an anchor to how I have to think about things, but ultimately, the counterbalance to that is protecting retail investors, protecting the integrity of markets, and making sure that there's sufficient economic reason for providing these products, and not suggesting that the 0 days don't have one. It's just a different structure and a different way to manage risk. But I have to think about these few components: who's investing, what potential risk or contagion risk can short-dated options have on the larger market when you have such sharp moves in short periods of time, pulling capital and collateral from different parts of the market, and how we can ensure that, A, there's a level playing field, among other things, but B, that you don't have those contagion risks and retail investors are aware of what they're investing in. And that becomes very clunky and complicated at times. I think there's a lot of content and a lot of access, but we need to make sure, especially with options and derivatives across the board, this information level is as high as possible, because the risk of loss is obviously severely higher given the leverage market. So, we're watching the markets carefully. We're engaging with the stakeholders. We're trying to put as many advisories and content out on our website to ensure that investors are aware of those risks. But, I come back to this often. I'm not here to decide how folks allocate capital. We just need to ensure transparent markets, fair markets, and information flow so investors can make the most informed decision.
Yeah, and we started out the conversation with crypto. It's been almost a year since the collapse of FTX. Notwithstanding everything that's happened with respect to the fraudulent activity, before all of that, the idea of disintermediation, of a startup being able to step into a traditional space and do something different. How has your thinking changed over the last year when you are looking at new market participants coming forth with interesting business models that might be different than what you have traditionally seen?
Yeah.
How's the approach different?
So a little bit of context for the audience, hoping that you don't know this, but I assume many of you will. It was a little bit of a weedy issue, but FTX had an entity that they had purchased called LedgerX, and it was a registered CFTC exchange and clearinghouse, and they had submitted an application to the commission to go from non-intermediated, fully collateralized futures and options and swaps to non-intermediated leveraged derivatives. So as you point out, Hope, that had been a significant shift in terms of market structure, a significant shift in terms of risk, and unknowns, I think, for both retail and institutional participants. And it was a very challenging exercise. I reflect on it, periodically, having started in 2021 and, ended in November this time last year when the entities went bankrupt. And I'll point out that the CFTC entity that was registered with us was one of the, I think, 3 or 4 entities within the FTX family that was not bankrupt. And I said this repeatedly to Congress to just sort of emphasize the importance of regulation and transparency and why we need this new authority over crypto. But ultimately, as I approach this issue and, the executive team, Bankman-Fried and others, and engaged. They came into the CFTC a lot, wanting this application approved in short order, and we had to manage that situation and think about the policy, think about the risk, think about what the statute permits or doesn't permit, and really just go through the exercise that we would do with any applicant. I said this about that particular application and its non-intermediated structure. It wasn't the first application we had around that type of structure. It probably won't be the last. But it was a unique one in the sense that it was a very well-heeled entity that was, coming at us quite frequently and wanting to get this application approved. But a few of the principles that I thought about in the early days was we have to treat this applicant like we would treat everyone else. We had to create a level playing field. So on the one hand, we had to treat them like everyone else, but we also had to treat everyone else like we would treat them. I know that sounds the same, but you can imagine no one gets special treatment, especially from a regulatory standpoint and a rule standpoint. And I wanted to be as transparent as possible, given, I think, the exposure and the notoriety of FTX and the importance of this particular issue, because as much as there was a lot of support for it, there was a huge amount of opposition to non-intermediation and the risk that it could cause in both derivatives markets and potentially contagion to non-derivatives markets. So we put out a comment period or a consultation document in March. We actually had a roundtable in May of last year, or a year and a half ago at this point, and just wanted to have a discussion and solicit as much feedback as possible, so whatever decision we make or made would have been grounded in data, facts, and the law above all else. So I think we did a pretty good job at that. Certainly, Monday morning quarterbacking would have done a few things differently, but that's life. I think nothing is done without imperfections. And ultimately, this led to the bankruptcy, which then, the application was withdrawn. But it definitely forces you to think about what I said earlier, this notion of supporting responsible innovation, which it sounds cliche, but the fact that that's in my statute is a really powerful thing. And it's in the law, right? It's not regulation. Congress said, I have to support responsible innovation. So we have to look at this. We have to look at proposals that disrupt, that change, that upset incumbents. And we have to really kick the tires and look under the hood and figure out whether or not this is legal, whether it's in the best interest of policy, and what kind of risk it would create for markets. And then ultimately balancing that against the law and how this would be, I think, accepted or entered into the marketplace, right? And that no one gets special treatment, as I said, and you have to conform with the law. We have a principles-based legal structure, so you can imagine there's room to say that you're complying with certain core principles, but ultimately it is, the letter and the spirit of the law that drive how we make these decisions. And again, it's a time of great change, great disruption, new market entrants, new investors, and having to field a lot of these new applications around crypto or around different asset classes in the climate space, voluntary carbon market. So it's consuming a lot of time, but I think it's a net positive for the agency and the country. And we're just kind of ticking through them slowly, intentionally, and trying to make the most deliberate choices, possible, without rushing and without, missing a beat.
I want to make sure that we leave a little bit of time for questions, but with everything you just, you have so much that you're tackling right now. We're careening towards November 17th. What happens to those market participants and with their new products and your ability to support innovation if the government shuts down? And then I guess the second part of that, how are you looking at 2024 and how does that impact, if at all, your operations?
Yeah, so I appreciate that tee up, because I would encourage all of you to talk to your members, your elected officials. Shutdowns are not good for us. They're not good on the enforcement side. And I know I could probably echo Chairman Gensler, because we sort of have the same restrictions during a shutdown. It locks down the agency, right? And there are very few activities that we can continue during a shutdown. So obviously the enforcement side is critical to customer protections, but registrations, applications, this is what makes our markets tick and go seamlessly and efficiently. And without that service from the market regulators, it becomes a huge burden. On the election side, it's business as usual. I'm obviously not immune to what's going on, and we're starting to see that rhetoric and the preparations for next year. But ultimately, we stay focused on what we do. We're an independent agency. I have an agenda. We want to finish through it. And then just dealing with issues, right? Whether it's COVID at the beginning of my term, the invasion of Ukraine by Russia, and now what we're dealing with in the Middle East and these geopolitical issues, which obviously have huge impacts on physical commodity markets. So this all goes down to the retail investor, the Main Street, American, and making sure that prices are reflective of supply and demand, and that markets are running well. So a lot goes on. We try to create a little bit of bubble and just stay focused on our job.
Well, I'm going to open it up with questions with our remaining minute or so. It's hard for me to see, but I'm sure people have them. Is there a mic?
You can shout it out.
Yeah.
We'll repeat it if you. Yeah, so the question is about our exchanges, or our clearinghouses, our derivatives clearing organizations, DCOs, buying FCMs, our essential brokers, and whether or not it's a concern. It's a great question, and one that I've talked about. It's essentially this vertical stack that's being created by single entities and creating this sort of seamless execution from customer to settlement, essentially, and not unlike what we were dealing with to an extent with FTX. We recently put out a request for comment specifically on this issue, on vertical integration and conflicts specifically. There is limitations in the statute which allow me or anyone on the commission to prohibit essentially M&A activity among registered entities. So you can have certain exchanges purchase brokers or vice versa on the clearinghouse side. But I would say two things. One, in many respects, the derivatives execution is vertically integrated, and it's built like that for efficiencies, for margining, cross-margining purposes, and liquidity pools. On the other hand, and the step towards FCMs, the broker side, is unique. And there becomes issues and questions around regulatory responsibilities of the exchange, because the exchanges do have a self-regulatory responsibility. And then the conflict of interest between the exchange and the clearinghouse regarding the clearing member, in this case the FCM, and preferential treatment that the single stack entity might have. So we are talking with stakeholders. We put out this request for comment specifically to solicit feedback, think about where markets are turning, and what pattern we're seeing in terms of this type of M&A activity, and what we would need to do from a policy perspective at the commission to create a very clear set of standards and rules around conflicts, so that you don't have this gray area emerge where you would have competitive advantages for entities that own multiple components of the trade exection, I'll call it that. But we're working on it for sure.
Okay. Well, great. Well, thank you again
Yeah,
for
my
offering
pleasure.
your perspectives to this group. Wonderful to have you here.